If you're a certain age, you'll need to take out required minimum distributions, or RMDs, from your retirement accounts this year. After being waived for 2020, those RMDs are again in force for 2021. To help explain the rules, Chris Burns with Burns Estate Planning joins us this morning. Hey, Chris, good morning.
Hey, good morning. How you doing?
I'm good, thank you. So can you kind of explain a little bit more for us about these RMDs? Some people may not have heard of them, especially people who maybe aren't in that age bracket that are affected by this. What exactly are they all about?
Yeah, sure. So an RMD stands for, as you said, a required minimum distribution. And that's on accounts that you haven't paid taxes on. Think of like your 401ks, your 403bs, your IRAs. Once you hit the required minimum distribution age of age 72, the government is going to want you to start taking those distributions so that you can start paying the income tax on those items that you haven't paid on up to that point.
Does the government, outline what you have to do with that money when you take it out?
So the government wants to make sure that you take out the correct amount. And after you pay the income tax on that, there isn't any rules of what you can and can't do with it. The only thing that you wouldn't want to do with it is put it back into the IRA, which you couldn't. So most people use it to supplement their income, or they'll help with their savings, or if there's some item like maybe like a credit card or something like that that they want to pay off. Most people use it for debt pay down or income at that age.
Or you could reinvest it, just not in that same account.
Most certainly, you can open up just a regular brokerage account and do as you please with it inside there.
So what happens if you don't take that money out?
Yeah, there's a 50% penalty on the dollar value that you don't take out. So say that you're supposed to take out $5,000, but you only take out $2,500. That remaining $2,500, you pay a tax penalty of 50%. So it's substantial. So making sure that you take the total amount is extremely important, because you'd be losing dollars that you've invested over the years just by missing it.
If you're somebody that doesn't regularly go to a financial analyst, how would you know about this, that you have to take this money out?
So once you start getting around that age, most places that manage investments are going to send out some type of notice to the individual, letting them know that, hey, look, this is the year that your required minimum distribution starts. And most places will even calculate it for you if they've had those assets from December 31st of the prior year. They'll help you calculate that dollar value.
Okay, and that's what I was going to ask. How do you know how much to take out?
Yeah, it's a formula that the IRS provides, right? It's not something that you'll have to do every year. So the big part is they'll take the dollar value of the account close of December 31st of the year prior, and then they'll use the formula that's readily available in the IRS table, and then that's how they'll calculate the value that the individual needs to take out.
And what about how they're taxed, the RMDs?
So the RMDs are taxed as ordinary income. So when those assets are taken out, the individual can control how much they'd like to withhold state and federal. So if you're working with like a CPA or you do your own accounting, you have a little bit of say of how much you should or shouldn't withhold from a tax standpoint. So you have control there.
Gotcha. All right. Well, Chris Burns with Burns Estate Planning, thank you very much for joining us.
All right. It's a pleasure. Thank you.